Every Lunar New Year, we have a dip.
Yeah.
Why is that? Well, because a bunch of people try to sell to fill up the red envelopes with money. And they sell, so we have a little dip in February, kind of ish. Well, then in March, madness, in advance of tax day in April, we have another sell-off.
Yeah.
And it's worse when we've had a really big year the year before.
Right.
Because if we had a bad year, no one needs to sell.
Right.
When we have a really great year, up 140%,
Yeah.
people got a lot of taxes. So we're seeing that coupled. So you got all these things, and we do this.
One of the first points Yusko highlights is the consistent dip in Bitcoin's price around the Lunar New Year. This is largely due to Chinese investors liquidating portions of their holdings to fund red envelopes, a traditional custom where money is given to family and friends. Despite China's official ban on Bitcoin, many Chinese individuals and institutions still hold significant amounts of the asset. This selling pressure creates a temporary dip in February, which history has shown to be a recurring trend. Following the Lunar New Year dip, Yusko points out another seasonal phenomenon, March Madness. As the U.S. tax season approaches in April, investors who have had a profitable year often sell assets to cover their tax liabilities.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Every Lunar New Year, we have a dip.
Yeah.
Why is that? Well, because a bunch of people try to sell to fill up the red envelopes with money.
Yeah.
No, China doesn't own any. Are you joking? Yeah, they banned it, but the Chinese own a lot of Bitcoin. So, especially people like Bitmain, etc. So they own a lot of Bitcoin, and they sell. So we have a little dip in February, kind of ish. Well, then in March, madness, in advance of tax day in April, we have another sell-off.
Yeah.
And it's worse when we've had a really big year the year before.
Right.
Because if we had a bad year, no one needs to sell.
Right.
When we have a really great year, up 140%,
Yeah.
people got a lot of taxes. So we're seeing that coupled. So you got all these things, and we do this. So if you go back to the 21 cycle, this happened. We peaked in January. And then Elon did his tweet, so it was a little early. You know, we went from 60s, and we went all the way down through July, back to 30,000, 32,000.
Yeah. Right.
Right back to fair value. And then we shot up all the way to 69 by November. I do this 10 surprises, and one of my surprises was, look, everyone thinks number go up, 4-year cycle's over. I'm here to say it's not. So what's likely to happen in my mind is we're going to have our typical crypto fall. It'll probably start summertime and go right through the fall. And we'll pick a number. If fair value is 85 to 90 today, by fall, it'll be 100-ish. Let's just call it a round number, 100. And that's because of Metcalfe's law, and you can calculate what fair value is. And Tim Peterson does a great chart on it. So all of that says, okay, in previous cycles, we've gone to 2 to 2.1 times fair value during the parabolic stupid phase. And what I mean by stupid, meaning when you pay 2 times fair value for something, you shouldn't expect to make a lot of return. Right? You should expect, it's like buying NVIDIA at $140. You shouldn't expect to make a lot before, you'll lose, and maybe you'll make money long term, but it was trading at 36 times revenues. So you shouldn't expect to make a lot of money. So this time, I think there's less leverage. There's still leverage. And everyone's been reading about this levered trader 40 times. Yeah, but 40 times is different than 100 times. Used to be 100 times leverage you could get. So let's say this cycle we go to 1.5, 1.6. So I said somewhere between 150 and 170 would be the peak. And then we would have another crypto winter. And so that's not like saying, oh my God, tomorrow we're going to zero. It's saying that humans are going to human. And we're going to push the price above fair value. And then we're going to push it below. Now look, if 106 was this cycle top, if they pulled that forward with all the nonsense, we're not going down much from here. I mean, we're below fair value. So there's not a lot of big leverage to unwind. There's not a lot of things that have to get undone. So unless we go to 150 to 170, then we're not going to have a correction. We already had it. And so is it possible that we're in a new era and we're going to kind of hover right around fair value and maybe just have a little bit of volatility around fair value and we're becoming a stable coin? I don't think so.
One of Yusko's major predictions is the inevitability of another crypto winter following the current bull run. While some market participants argue that Bitcoin's volatility is decreasing and that the asset may start to behave like a stable store of value, Yusko remains skeptical. He suggests that unless Bitcoin reaches an exaggerated peak of $150,000 to $170,000, there may not be a major correction. However, if it does reach those levels, history indicates that a subsequent bear market could see Bitcoin retracing significantly. This is not a sign of fundamental weakness, but rather a reflection of how human psychology and market cycles operate.
Every 4 years, you cut the number of block rewards.
Right.
Okay, well, why does that matter? Well, in theory, if you do that, half of the miners would go out of business, right? Their costs are fixed. So they will hold their coins until someone bids them higher because they need to pay the bills. So there's a built-in price escalator every 4 years. Okay, great. Why does that matter? Well, that attracts attention, right? I mean, guys in particular, I say, if somebody were to walk down the hall, I would look at them because guys, we're hunters, right? Our eyes follow movement. I joke all the time. My wife says, get the ketchup. I open the door. Honey, there's no ketchup. She walks up, she grabs the ketchup. If it ain't moving, I can't see it. And that's just reality. And so this price starts to move and that attracts attention and attracts capital and we start to move again. And so normally that halving event occurs toward, crypto summer. So we're starting to get back toward fair value after the last crypto winter. We go through winter, we go at the fall. Then you have this year of, spring. And spring is kind of yucky. It's windy, it's cold, it's wet, it's mushy. And so you're kind of bouncing along the bottom, starting to drift up. And then in summer, you start to head back toward fair value. People, the normal participants, investors, say, that asset is trading below fair value. I should buy some. Okay, that makes sense. And start to move towards fair value. The halving occurs. Well, now suddenly the fair value doubles, right? Now, no, it doesn't make sense. So, it actually does, but let's just think about the math. So now the traders get involved because now things starting to move, right? People who watch the show, they're like, I don't really care about fair value. I just need movement. I need to scalp some profits. Well, then as we get to fair value, right? And then the miners say, once it's above fair value, the miners are like, okay, I can sell. I can pay my bills. Okay, good. So now we start to get above fair value. Now the speculators come in. Well, what's a speculator? A speculator is the opposite side of a hedger. Well, what's a hedger? A hedger is like a miner or an oil producer. You are selling your product forward in the market, and the speculator takes the other side. That's all that means. Now, there are other types of speculators, but that's generally what happens. Well, so then we're where we are today. We're in crypto fall.
Right.
And you start to see the price move away from fair value. Well, then the gamblers come in. And the gamblers, they don't give a shit about fair value. They don't care about anything except, hey, I can buy this. I can buy it on leverage. So they lever up and we start to go parabolic. Now, some would argue, well, that's what happened in December, right? All this, enthusiasm about the strategic Bitcoin reserve. We went well above fair value. Fair value was 85. We got to 106. And now they're like, oh, it's over. We missed it. I'm like, no. So yes, there was buy the rumor, sell the news, right? It was clear to anyone who did a little work, public enemy number one is a scoreboard for thought.
Yeah.
Right?
Yeah.
That's why people hate Doge. I mean, and to your point, inflation, that thing that's supposed to be good for us, and what people just don't remember because they don't study history, from 1776, when this republic, we're not a democracy, we're a republic, by the way, when this republic was formed, till 1913, a dollar, which came from the original Reichsdollar, like why did we take a name Reichsdollar? But
Yeah.
that's another story. So a dollar was worth a dollar. Okay? Had a little fluctuation around wars and the free banking era, but a dollar's worth a dollar. There was no such thing as inflation. Since 1913, that dollar has turned into 3 cents. Jay Leno joke, I heard we're going to do a dollar coin. Well, we already have. It's called a nickel. And so that theft, because here's the thing, why would a plan that takes half my purchasing power every 30 years be good for me? That makes no sense. And everybody's like, oh, but my house went up. No, it didn't. Your house did not grow. It did not get more efficient. It actually wore out. You had to put money into it. Your money got worse. And so Bitcoin as a scoreboard, or gold as a scoreboard, you're right. They don't like it. And so I also agree with the point on paper versus spot. What we'd really like is for everyone to have, a wallet and everybody to use this to exchange value in the peer-to-peer electronic cash. Not that we have to buy coffee with it, but if I want to send you value, we don't need to go through a bank and pay wire fees.
Yusko also touches on the broader economic implications of Bitcoin. He criticizes inflation as a hidden tax that erodes purchasing power over time. From 1776 to 1913, the U.S. dollar maintained relatively stable value, but since the creation of the Federal Reserve in 1913, inflation has significantly devalued fiat currency. Today, $1 is worth only 3 cents in terms of its original purchasing power. Bitcoin, by contrast, serves as a hedge against this monetary debasement. With its fixed supply of 21 million coins, Bitcoin is a digital alternative to gold, acting as a store of value in an increasingly inflationary world. Yusko sees this as a key reason why Bitcoin adoption will continue to grow in the long run. Please like and subscribe.